The last thing an investor wants to see is a dividend cut to one of their companies, and today we're going to look at 10 dividend stocks that have either a very unsafe score or an unsafe score on that dividend safety. We're going to talk a little bit about the company's historical performance. We'll also mention what the ratings are by the different analysts, and what we'll ultimately do at a very high level is tell you what we see the intrinsic value to be for each one, what we see as the acceptable buy price, as well as what Wall Street forecasts, given that there could be a potential dividend cut for each one of these over the next 12 months. Typically, one of the major reasons for these potential dividend cuts is when they have a significant amount of debt, and one way that we can see this is looking at the net debt to EBITDA metric, which refers to the earnings before interest, tax, depreciation, amortization. Now, these numbers on a year-by-year basis show us the number of years it would take the company to pay off all of their debt net of cash on hand. For this example, for MPW, we can see it is well above in 23, 14.27, above the maximum we want to see of 6 for this industry, and you can pretty much assume that throughout the episode, for the other 9 that we will look at, they have some very similar fundamental issues. So we won't look at the metrics in too much in today's episode. Again, it is just very high level. First one we're looking at is MPW. Now, we can see they have had a dividend cut not too long ago already, negative 48% last summer, and this is a company, when we do take a look at it, that is trading right there towards its 52-week lows. It has a strong sell from Quant, a double hold from the other two analysts, and we can in fact see that right now, if you are a shareholder on a forward-looking basis, your yield would be just below 13%. Now, over the last year, it has been hammered down around 48%. Over the last 10 years, if you have been a shareholder, well, you would be down around 64%. And we can see that all-time highs sit around the $24 to $25 mark. Now, again, typically on this channel, we will run into the metrics like we usually do, but for today's episode, we're just going to take a look straight at the valuation as well as their dividend safety score. Now, on this channel, what we do is we run through every single one of these models in detail. For example, we go through each model, Graham's multiples, the DDM, the DCF model to get to our intrinsic value. Today's episode, we're going to jump straight into it. Again, very high level. We get to around $5 for MPW, and we can see, based on the current price at $4.68, the margin of safety will be minimal. So MOS, we typically start off with 10%, and we execute on that if we believe a company meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. For MPW, it barely gets a 10% margin of safety, and in terms of the forecast with Wall Street over the next 12 months, they see upside of around 7%. As we can see, their price target of $5 is pretty much in line with where we see the company in terms of its intrinsic value. Do let us know your thoughts in the comments as we do go along these next 9 stocks as well. The next one we're looking at is AGNC. Now, this is a mortgage REIT. We do actually get a buy rating from Wall Street, a hold from Seeking Alpha. It is trading towards the upper end of the 52-week range. We also note a very high forward yield, just under 15%, a forward P sitting at 4.52, and over the last 12 months, it is down around 5%. Over the last 10 years, it has been in that downward trend, negative 58%. Now, in terms of their dividend safety, well, they get a 23 score. It does look to be unsafe. They haven't increased that dividend since 2020, and right now we do, as we said, see a very high yield for this company. In terms of the valuation then for AGNC, in terms of what we get, it is the average of these two models, coming at just under $12. In terms of the margin of safety, then, a 10% margin of safety would indicate a buy at $10.57. Remember, that is if you do believe in these companies long term and you are happy with these MOS levels. 15% a buy at just under $10, and right now it isn't at that 20% just yet, somewhere between a 15 to 20%. In terms of Wall Street and their forecast, well, over the next 12 months, they see very limited upside, 3% with their price target at just under $10. Now, before we continue, just to let you know, we have released our latest free weekly article where we run through 10 undervalued stocks. Unlike these companies, they have excellent balance sheets, so if you do want to grab a copy, completely free, do click on that pinned comment below. You'll also get instant access to read all of these other articles and more. The next one that we have is Vodafone. Now, in fact, we have a strong buy from Wall Street. 4.75 out of 5 is pretty high. We get a double hold from the other two analysts with a yield. Again, these are very high yielding companies, some of them just under 11%. Forward PE just under 24, not far off the S&P. And over the last year, down 2%. Over the last 10 years, down 74%. So we are starting to see a theme. These companies do pay a high yield, and they have had some historically terrible performances. In terms of dividend safety, well, 30 unsafe. We get a market cap 24 billion, and again, they haven't increased that dividend just yet over the more recent year. In terms of Vodafone and where this price is moving towards, well, the intrinsic value, and don't forget you can grab a copy of this model by clicking on that pinned comment below, getting to both intrinsic and acceptable buy price of companies in your own portfolio. Margin of safety then, 10% indicating a buy at 10.16, 15% around 9.59, and at 20% pretty much on the current trading price. Now, if you are happy with the metric, do let us know if any of these you do believe to warrant an in-depth dive. We can take a look and see whether or not it is justified in terms of executing on these companies where they do look like a dividend cut is likely. In terms of Wall Street, well, they see the price not too far off the intrinsic value, so at a high level, this could actually be a decent one to consider if you are happy that over the longer term, they may cut their dividend. Margin safety, 20%, Wall Street indicating 22% upside. We then move to Paramount Global, where we just get one buy from Seeking Alpha, a double hold. Again, yield actually, interestingly, is quite low, below 2%. Forward P around 8, and we can see trading towards the 52-week lows with essentially a negative 36 performance over the last 12 months. Over the last 10 years, pretty horrific, down negative 85%, probably the worst one that we will see in today's episode. In terms of dividend safety, well, 40, so another unsafe score. Market cap 7 billion, and again, they haven't increased that dividend in quite some time. In terms of the valuation for Para, it is coming in today's episode at a total price of $9.19, and we can clearly see here that that is essentially lower than the current trading price. Therefore, a 10% margin of safety would be below the current price, $8.27. So right now, we actually see this company trading above its value. And in terms of Wall Street, well, they actually disagree. They believe there is a lot of upside. Analysts giving this a $12.83 price target over the next 12 months, seeing upside of 28%. We then move on to IRPR, which we have a triple hold rating, a yield on a trailing 12-month of 6.6%. We know that it's trading towards its upper end of the 52-week range and has had some strong performances over the last 12 months, up 50%. Over the last 5 years, though, it is still down negative 17%. In terms of dividend safety, well, 40 unsafe, does have a 3.1 billion market cap, so a mid-cap company, and they did in fact increase the dividend this month at 4.4%. In terms of the valuation for IRPR, intrinsic value, we are using these three models, is arriving at $123. So it does look like to have some margin of safety, 10% a buy at 111, not quite there at 15%, so we would say more towards that 10% level. In terms of Wall Street and their forecast, well, they believe it will go higher than our intrinsic value calculated. They see 23% upside for this company. We then move on to LC Properties, where we have one buy rating and a double hold, another high yield just under 7%, a P to FFO forward of 12.64. It is trading in the mid to upper end of the 52-week range, and in fact is pretty much flat over the last 12 months. Over the last 10 years, down 14. In terms of dividend safety score, well, 40 unsafe, 1.5 billion, so a small cap company in fact, and they haven't increased their dividend in quite some time. In terms of the valuation for this company, in today's episode, we are arriving at essentially $32.42, and we can see that the current price trades higher, so another one that we see trading at a premium. At 10%, you would be looking around $29. In terms of Wall Street and their forecast, well, over the next 12 months, they see relatively minimal movement, as we can see, in fact, negative 1% downside to this company. We then move on to Rio Tinto. Interestingly, another one with a strong buy from Wall Street, quite high, in fact, 4.83, one buy rating and a hold from Quant. Trading pretty much bang in the middle of the 52-week range, a nice forward yield, 7.8%, a low PE, 9.15, and we do see over the last 12 months, up 5%, over the last 10 years, up 29%. In terms of dividend safety score, well, 40 unsafe, market cap 113 billion. This is a mega cap company, and we already see a dividend cut 22 to 23. As always though, if you do enjoy this content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos, and also let us know if any of these you do feel warrant an in-depth look. $79.46 with a current price of $67, so this does look to have a large margin of safety, and as we can see, not at 20% just yet, somewhere between a 15 to 20%, although again leaning more towards that 15% level. In terms of Wall Street, well, they agree with our intrinsic value, although they do see this reaching over the next 12 months. They see implied upside of 17%. We then move on to what has been a horrific stock, Walgreens Boot Alliance, a triple hold, forward yield of 6.37%. Again, it has been right there towards their 52-week lows with a forward P of just under 5, down in fact more than 50% over the last 12 months. Over the last 10 years, pretty horrific downward trend, negative 79%. We get a 30 unsafe dividend score, market cap just over 13 billion, a large cap company, and on the dividend growth, just in fact this year we did have a negative 48% cut, and what this signals is that there would be no surprises here if we do get another cut over the next 12 months. In terms of the valuation then for WBA, one that we haven't covered in quite some time, we can see that the intrinsic value, the average at $18.94, with a current price, it does show some margin of safety. 10% will buy up to $17.05, 15% around $16.10. Not quite at that 20% MOS level yet, but not too far off it as well. However, on the other side, what we notice, Wall Street do believe the share price will rocket quite significantly, 36% over the next 12 months at $21. We then move on to VF Corporation, just a buy rating from Seeking Alpha, a double hold from the other two. Forward yield on the lower side today, 2.55, forward P just over 20, trading towards the lower end, mid to lower end in fact, of the 52-week range, down 24% over the last 12 months. Over the last 10 years, down 76%. Again, another horrific downward trend graph. And we do note dividend safety score 40, unsafe, a mid-cap company, and they also had a dividend cut just last year, negative 70%. In terms of the valuation of this company, today we just see the DCF model to be the one to be accurate. And again, we have also reviewed this in detail not too long ago. We believe this is pretty much trading right around its current price as the intrinsic value, so no margin of safety. In terms of Wall Street, but what they believe is the share price will go down 13%, price target just over $12 over the next 12 months, and don't forget to let us know your thoughts below. Finally, we get to Omega Healthcare Investors, a REIT. We do actually get a double buy rating, including Wall Street, the holders from Seeking Alpha, trading towards the upper end of the 52-week range, a forward yield of 8.06, and a P to FFO of 12.07. Over the last 12 months, we're up 11%. Over the last 10 years, down around 9%, so not the greatest historical performance. In terms of dividend safety, well, 40, again, this does look to be unsafe, and they also, similar to others today, haven't increased that dividend in quite some time. So in terms of the valuation, don't forget as well, you can click below, grab a copy of these models if you want to put your own numbers through, or if you want to run companies in your portfolio or watch list. Margin of safety then, pretty much a no margin of safety, so we also see this one trading at its intrinsic value, and when we look to Wall Street, they pretty much also agree this does look to be a company with no upside over the next 12 months and trading pretty much in line with that intrinsic value. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Let us know your thoughts below if any of those you do believe warranted an in-depth look to see if there is any value, even if a dividend cut is to happen over the next 12 months. As always, take care and see you all on the next one.